What's up, guys? Welcome to What I Think, your number one stop for investment tips. So today I'm talking about options, details on the kind of options you can buy that you don't lose your money, because option can be very risky somehow, but I'm here to give you the information on how to trade it without risk, where you can win on both sides. When you're losing, you're winning. When you're winning, you're winning. Sounds funny, right? But it is true. So today I'll be talking about sell put. So when you talk about sell, it means that you're selling something. Okay. So this is how it works. But if you've not watched my previous video, if you get a chance, you can watch it. The link will be in my bio. So what is it all about? Let me just recap what option is. Option is a contract. It's a contract that you are willing to go into a particular business with a particular price and with a particular down payment, if that makes sense. Okay, going with the technical terms, we have the strike price, which is the price you are agreeing to buy the particular stock per share. Then we have the premium, which is the money you are going to pay, or which the money they are going to pay you to be able to execute the contract. Not really execute the contract, to be able to carry out the contract or the option. So, like the part I'll be talking about today is the sell put. So sell put has to do with you agreeing to buy a contract or contracts. And last time when I was talking about the option, a contract is 100 shares. Okay, so when you talk about one contract, you're talking about 100 shares of a company. It can be either Apple, it can be either Facebook, it can be either Amazon. Depends on whichever company you really want to trade your stock. So when you go into a contract, you're saying, okay, I want to buy 100 shares of Apple at this price. So let's say, for example, Apple is trading now for, let's say, 130. You can say, if Apple goes down to 125, I'm willing to buy 100 shares of it. Okay, so when you go into such contract, you are paid a premium. That's when you're selling put. But when you go into the contract for call, you are paying that premium. But the beautiful thing about sell put is that when you go into this contract, or which is the option, you get paid instantly. Okay, so how does it work? Bear with me. I'm going to try to explain it as much as possible so that you can get a perfect understanding. So this is it. This is how it works. So consider the fact that now you want to get 100 shares, but you don't want to buy it at the current market price. You're believing or expecting it to drop. So now you go to your brokerage, which apparently now is easy to do because you can do it with other Robinhood, Webull, and other option. Fidelity, I think Fidelity does option trading too. But I'll be going to the platform you can use to trade these options in my next video on how you can do it, where I'll give you the practical details. You'll see me do it, and then you know how it really works if you don't get the proper understanding of what I'm talking about here. But here is just to prepare you, to give you clear understanding of how you can be profitable in this business of option trading without eventually losing your money. So as I was saying, sell put. So now you go into a contract, you're saying that, oh, I want to buy 100 shares of Apple, but I only want to buy it when it drops to maybe 120 or 125. But currently Apple is trading at maybe 130. So now you launch your brokerage platform, maybe Robinhood. You put in the sell, the sell option, and you put in put. So now you select the particular strike price you're willing to buy. You select it, and you are paid a premium. The premium is what you get. It's like, how am I going to describe it now? The money they are taking from the other person, which is buying, call. This is how it works. So you are being paid a particular amount, which is going to be the premium. Let's say the premium can be 150, can be 120, can be 80, can be 100, depends. When we go through the practical process, you get to see for yourself how it works. So now you are going to be paid instantly, premium. But the thing is that premium you are paid is not refundable. Once you are paid that money, is yours. You can do whatever you want to do with it. Go buy coffee with it. If it's maybe good enough, you can buy shares with it from other companies. It depends on you. Whatever you want to do, that's your choice. So when you pay this premium, you've already entered the contract. And in every contract, there's an expiration date. So the expiration date is, varies. The expiration date varies. So let's say there are some contract that can be for a week. There's some contract that can be for 2 weeks. There's some contract that can be for a month. So it all depends on the particular company stock you're dealing on. So let's say the expiration is for a week. So now you've entered the contract. You'll be given the expiration date, but it's not just going to be easy like that, right? You just say you want to buy a particular share at a particular price, and what happens if it doesn't get to that price? Good question. If the price does not drop to the particular price you selected, which is the strike price, you still get to keep your premium, whichever case. Keep the money that you're paid. That money is yours. So if it keeps increasing, there's nothing to lose. You still keep the money. But if the price drops to the strike price which you entered, you are automatically forced to buy the 100 shares. Okay, you are forced to execute the contract. Now, in order for the brokerage to be sure that you are not just going to get this premium that they pay you and disappear, then you have to drop collateral. And so let's go back to Apple, using Apple stock as an example now. So let's say you're willing to buy Apple for, let's say, 125, and Apple is currently trading for 130. But you need to have a collateral of 1,000, oh sorry, not 1,000, of 12,500 if the strike price you selected is 125. You need to have in your trading account 12,500 to be able to execute, to be able to go through with the contract. Okay, let me pause there, take a deep breath. So let me go over it again. When you say I want to sell a put, what you saying that, okay, I'm going into a contract. I will know contract is an agreement. So now you've agreed to buy Apple stock for 125, but it's currently trading for 130. So, excuse me. Now that it's trading for 135, but you are willing to buy it for 125 if it drops, you are paid a premium for that, which you are going to keep irrespective of what happens. Either the stock goes up or comes down, that money is yours already. And there's an expiration date. The expiration date has to do with when the contract is going to expire. The contract can be for a week, 2 weeks, 3 weeks. Okay? So now, the final one, the collateral. The collateral is the set aside amount, which oftentimes is the equivalent of the strike price that you've entered for 100 shares. So if a stock is trading for $50, and you say you want to buy it for $40, so 100 shares of that particular company trading for $50, if it drops to 40, 100 will be how much? That will be 4,000. So you need to have 4,000 to be able to execute the contract when the need arises. So the brokerage is going to take that particular amount from you and hold it until the expiration of that contract. So going back to the Apple example, now you've agreed to buy Apple for $125. So the brokerage is going to hold in their own account $12,500 of your money for, depends if it's going to be a week or 2 weeks, depends on what time you set aside for it. So if the expiration is a week, the brokerage are going to hold the collateral for a week. Then if it expires and doesn't drop to that particular amount, which is $125, you are paid back your collateral and you still get to keep your premium. So if it increases, you don't have to worry about it because the contract is not going to be fulfilled. But mind you, if it drops below 125 or 125, then they have to execute the contract. Okay, is that understood? So that is one way you can make money on option trading without bearing any risk. But in the next video, I'm going to teach you how you're going to make profit too if eventually the price drops to the strike price, which is, for example, I'm using Apple. If it drops to maybe 125 and you have to execute, which is you have to buy the 100 shares. I'll also teach you how you can use that to your own advantage, because now you're not going to have 100 stock or 100 shares of that particular company, which you can also resell and make more profit. But this will be coming in the subsequent video. So, but for this one, I just wanted to share with you how you can make money with selling put. Selling put is one of those easy ways you can get quick money if you are not, if you are afraid of trading stock because of its volatility. You can use this one and make some extra quick cash in a week. So it depends on how much you have. You can make as high as maybe 300 a week, but it all depends on the capital you're willing to put on ground. So that's it, guys. So if this video was helpful in any way, please like, share, and drop your comments in any area that you don't understand so I can explain better. But do me a favor, if you like this kind of content, don't just go away without subscribing. Please subscribe so that you can get updates on subsequent videos as I drop them. But this time I'm going to teach you guys everything I know as regard investment, so you have nothing to worry about. Okay, I'm going to hold your hands and guide you through all the process. We'll be doing the real stuff soon, but I just wanted to clear some areas which are very important that you need to understand before going in details. I'll be talking about the app you can use, brokerage free app you can use, and details on how you can use them. We have Robinhood, we have Weibo, we have Fidelity. I, for one, I use all of them, okay, to trade. So what you have to learn some of these things, but that's what I'm doing now. Before you start doing the real trading, you need to understand how it works, so that when you're doing it, you know exactly what you're doing. So, alright guys, so don't forget, like, share, subscribe. I'll see you guys in the next video.